Good evening, everyone. I'm Laurent Deville, Professor of Finance at EDHEC Business School, and tonight I will be hosting this episode of the EDHEC Business School Future of Finance Speaker Series with Dave Rapach, who is Financial Economist and Policy Advisor at the Federal Reserve Bank of Atlanta, and Abraham Louis, Professor of Finance at EDHEC Business School, and Thomas Rein, one of our great students from the MSc in Financial Engineering. So just to introduce David pretty briefly, Dave Rapach has a strong expertise in the field of asset pricing and specifically in asset return forecasting. He has been publishing numerous papers in top financial and economic journals, among which the Journal of Financial Economics, Management Science, Review of Financial Studies, among others, just to cite a few, only in the field of finance, but he also have numerous publications in economics and econometrics. So after having been professor of economics at the St. Louis University Chaffetz School of Business, he is currently at the Federal Reserve Bank of Atlanta. And today, Dave is going to talk about one of his last papers, The Anatomy of Machine Learning-Based Portfolio Performance. Although this may look quite technical, so I think this is important that we have a perspective to understand how we can identify the key drivers of machine learning models in portfolio construction. Although these tools are becoming quite popular recently, they often work as a black box, and it's not always easy to understand the real drivers of the performance. And so I hope that once we have seen your presentation, Dave, we will be more fluent into this perspective and will understand better how these things can be kind of valued in a sense. So after your talk, David, we'll have the chance to start discussion with Abraham and Thomas. And so thanks a lot for the three of you to be with us tonight. And without further ado, Dave, the floor is yours for the next 30 to 35 minutes. Thanks a lot.
Thank you very much, Laurent. That was a very kind introduction, and you were spot on in highlighting what I'd like to cover and what we what's at the heart of the paper. I've been working extensively with machine learning in the context of prediction, of course. I'm probably best known for my research on asset return prediction, as you referenced. But I just do prediction and forecasting more generally, including macroeconomic variables. Again, these days, one certainly has to consider machine learning models, but they can certainly be black boxes. And it can be very difficult to understand how these models work. And so I've become keenly interested in model interpretation tools, how to use them and to further develop them. And here from a finance perspective, yes, we're going to use machine learning models to generate return forecasts. They're going to serve as inputs into a portfolio optimizer, and we're going to see how the portfolio performs. And then we want to ultimately, because the machine learning model is essentially a black box, we want to get a sense of, well, if the portfolio performs well, we'll do an empirical application where a portfolio, I hope you'll be convinced, performs quite well. We want to understand, well, what's driving the portfolio performance? Are there particular, which predictors in the model are primarily responsible for the strong performance, for the outperformance of your portfolio, and what other predictors may detract from performance? So just understanding, as we work with more and more complex machine learning models, AI type of resources, understanding what's going on inside these black boxes is vital. Just in terms of how to use machine learning as best we can. And even just from an economic perspective, right? I mean, we want to have a handle on what's happening, even just to develop our intuition and to try to learn from these models and to guide the development of theory. So thanks again for the introduction. So it's based on a paper that's co-authored with Philippe Goulet-Coulombe, Eric Christian Monteschuta, and Sander Schwenk-Nebe. I need to give the standard disclaimer because I do work at the Federal Reserve Bank of Atlanta, so I want to make it clear that the views that I express here are solely my own and not necessarily those of the Federal Reserve Bank of Atlanta or the Federal Reserve System. At the risk of stating the obvious, return predictability, it's clearly a leading topic in empirical asset pricing, and one that's near and dear to my heart, and I've spent countless, too many hours pursuing return predictability. Out-of-sample tests are now routinely employed. So sort of the first generation, if you will, of studies on return predictability were primarily in-sample, but starting with the influential work of Goyal and Welsh in 2008, out-of-sample testing became quite important, and I've focused on that indeed in my research. And when it comes to so-called big data and machine learning, out-of-sample tests are certainly viewed as the most rigorous and informative tests, and there's again, the nice book by Nagel, and then this very interesting paper by Ian Martin and Stefan Nagel. Now, when we're analyzing out-of-sample return predictability, in addition to statistical accuracy, it's commonplace, not surprisingly from a finance perspective, to analyze the economic value of return predictability via asset allocation exercises. Again, we still are very much interested in statistical performance using conventional criteria, MSE, MAE, what have you. But ultimately, from a finance perspective, we're interested in the economic value of return predictability. And so what is often done these days is, so we'll generate return forecasts based on typically a large set of predictors, and these will serve as inputs for constructing a portfolio. And then for this portfolio that you construct, again, using out-of-sample return forecast that you somehow generate using maybe a machine learning model, we just analyze the performance of the portfolio over a forecast evaluation period. And we often compare it to some benchmark, maybe seemingly naive for benchmark portfolio, or something, depending on the context, maybe something like a broad value-weighted market index portfolio. And this enables us to measure the economic value of return predictability. And indeed, a spate of recent studies follows this tack. So these studies examine cross-sectional firm-level return predictability. So they use a plethora of firm characteristics to forecast out-of-sample cross-sectional returns. You're probably maybe familiar with a number of these papers, especially the Gu et al. Paper. The last paper happens to be mine. And basically what these papers do, again, so essentially each month you construct a long-short portfolio by taking a long position in stocks that have the highest forecasted returns for the next month, and you take a short position in stocks that have the lowest forecasted returns. These return forecasts are generated using machine learning methods. In these papers, we find that indeed these types of long-short portfolios based on machine learning forecasts of individual stock returns provide substantive economic value to investors. And so this can be construed as strong evidence of the relevance, right, the importance of cross-sectional stock return predictability, that it exists and it's economically valuable. However, as Laurent emphasized, the existing literature does not necessarily tell us how individual or groups of predictors in fitted machine learning methods are contributing to out-of-sample performance. Here we focus on the economic value, right? So again, we have these machine learning models. We have a large number of predictors, large information set, big data, if you like, that we use to generate forecasts. These forecasts appear to be economically valuable, but I mean, which predictors are most relevant? We don't get a sense of this by just generating results. So the idea is to use what we think are the most sophisticated tools, namely tools based on Shapley values, to measure the contributions of the individual predictors or groups of predictors to portfolio performance. So essentially what we're going to do is we're going to use the logic of Shapley values to fairly allocate the contributions of the predictors in our fitted prediction models, our fitted machine learning models, to portfolio performance. Why do we use Shapley values? Well, in the now vast machine learning literature, Shapley values are certainly one of, if not the most popular model interpretation tool. And this is primarily because Shapley values have a number of attractive properties. And I'll talk a bit about these properties, especially so-called efficiency or local accuracy. And by using Shapley values, we're going to develop a version of Shapley values that will enable us to exactly decompose portfolio performance. For example, think of the Sharpe ratio. We're going to be able to exactly decompose the Sharpe ratio into the contributions made by the underlying predictors in your model. So we're going to be able to say, this predictor contributed this amount to the Sharpe ratio. This other predictor contributed this amount to the Sharpe ratio. So we can identify which predictors are primarily responsible for economic value, right? Allowing us to peer inside the black box to better understand the roles of, again, individual predictors or groups of predictors in determining economic value. And we develop a new metric that we call the Shapley-based portfolio performance contribution, more affectionately known as the SPPC. We have a subscript P here for predictor P, right? So for each predictor in the model, we actually work with groups of predictors. For each group of predictor, we're going to compute the SPPC for some performance metric. Could be a Sharpe ratio, could be an alpha, what have you. So basically, to get where we want to go, we're going to have to extend the way conventional Shapley values are used in the machine learning literature to measure the contributions of individual predictors to the following. And out of sample return forecast, conventional Shapley values are typically used to measure the fitted values or in-sample predictions. So we're going to have to focus on out-of-sample forecasts. And then we're going to need to be able to measure the contributions to a portfolio return in a given month. And then finally, a performance portfolio metric, where we take the portfolio return over a sequence of months, compute some overall measure of performance, and then we want to measure the contributions again of each predictor to the portfolio performance metric, resulting in our SPPC. I want to emphasize that our SPPC is very flexible. It's model agnostic, and it can be applied to any prediction model. It can be used for any machine learning model that you want to use, or any model that you want to use for that matter. It can be used for any strategy that you use for mapping return forecasts to portfolio weights. So you could just construct a long-short portfolio, as existing papers typically do, but you could also construct some sort of mean variance optimal portfolio. And indeed, there are some nice recent papers that actually estimate portfolio weights directly using predictors. So instead of using predictors to forecast returns, and then using the returns as inputs to compute portfolio weights. You just directly estimate the portfolio weights using some type of machine learning device. So we can accommodate that approach as well. And of course, as I've already intimated, we can use it, it can be computed for any performance portfolio metric. So Sharpe ratio, alpha, Kalmar ratio. We consider a number in the paper. The paper includes an extensive empirical application similar to the recent studies. We have more than 200 firm characteristics. We forecast individual stock returns using many of you may be familiar with this, the powerful XGBoost. It's a gradient boosting tree. It's quite a powerful algorithm. It usually does quite well in forecasting competitions. So we're going to use that. It seems to work well in our application. And again, we're going to generate, using the XGBoost, we're going to generate individual stock return forecasts using a large number of predictors. Each month, at the beginning of each month, we're going to take the return forecast for that month. We're going to sort them, and we're going to take a long position in the basically top quintile of forecasted stocks with the top quintile of forecasted stock returns. I think that's right. And take a short position in the stocks with the lowest quintile of forecasted returns. The long-short portfolio, in perhaps my humble opinion, performs impressively with a Sharpe ratio of 1.80 in large alphas in the context of multi-factor models. So, Laurent, 15 minutes, how am I doing?
You're doing very well, Dave. So it's
Okay,
been 15
I
minutes.
still have
you have 20 minutes.
Okay, great.
Your 20 minutes. Please go.
Okay, thank you. So when we apply our new metric, the SPPC, we create 20 groups of predictors, and then we measure again the contributions of these groups of predictors to the portfolio performance metrics. And it turns out that some groups of predictors certainly stand out. So the risk, earnings, seasonal momentum, and momentum groups, these groups make the largest positive contributions to portfolio performance over our entire forecast evaluation period. So these types of predictors, these groups of predictors seem especially important. Earnings, seasonal momentum, and investment, these groups make positive and sizable contributions to portfolio performance on a consistent basis over time. So if you compare the second and the third bullet, perhaps the implication is risk and momentum, those categories, while they make large contributions overall, they don't make large contributions on a consistent basis. So in the first part of the forecast evaluation period, risk and momentum perform quite well. They're responsible for sizable portions of, say, the large Sharpe ratio. But then toward the end of the forecast evaluation period, they actually detract from portfolio performance. So we can use our metrics to measure contributions for the overall forecast evaluation period, but also for subsamples or in rolling windows. So we see important time variation in the contributions. And there are some groups that just tend not to do well on a consistent basis. For example, sales and ownership. Now, if you're not familiar with Shapley values, I mean, I've learned about them fairly recently. I didn't have an extensive background in game theory, but but I've learned a lot about Shapley values recently. I don't have time to go into the excruciating details. Let me try to provide some intuition as to how we use Shapley values to measure the contributions of predictors to a forecast made by a model, and then ultimately measure the contributions of the predictors to portfolio performance. So Shapley values are a canonical solution method for fairly allocating the payoff to the players in a coalitional game. So you have a group of players in a coalitional game, they earn an overall payoff. So the seminal paper by Shapley comes up with a solution strategy to fairly allocate the payoff, the total payoff among the individual players. The solution has a number of attractive properties, which makes it, again, a seminal contribution to game theory. In the machine learning literature has basically leveraged Shapley values to measure the contributions, to try to fairly allocate the contributions of predictors to the prediction made by a model, right? So we just draw the analogy between players in a game earning a payoff and the predictors in a model making a prediction. Some of the most important papers are by Strumble and Kononenko and Lundberg and Lee. And so we're basically going to adapt Strumble and Kononenko. We focus in the paper on a setting where we have a panel model that we're using to forecast individual stock returns using a large set of firm characteristics, but everything generalizes to any type of prediction model for any asset return. So just briefly in terms of notation, we'll collect all the predictors in this index set cap S, and we'll index individual predictors by P. And the cross-sectional units will be contained in the index set cap C, in our cap N cross-sectional units. We'll have a P vector of predictors for stock I in period T. The return is going to be, R sub IT. And then here's our prediction model written in a very general form, right? So the return on stock I in period T is a function of the vector of characteristics for stock I in period T, right? So we predict the returns in the next month, the return in the next month for a given stock using, right, a vector of its value for its characteristics in the previous month. And then we have the ubiquitous disturbance term. And F hat will denote the fitted model, and WJ will collect the observations that we use to train the model. And so then a fitted prediction model evaluated at XIT, so we plug in XIT to get a forecast of RIT plus 1, is denoted here by F hat, and then WJ just reminds us of the training window for the model. Now again, the notation gets quite heavy here, so let me just provide some intuition. What underlies Shapley values? Forming coalitions. Okay, in a coalitional game, coalitions of players, we form coalitions of predictors. So let's suppose we have 4 predictors. Let's form a coalition of the first 2 predictors. So what we want to do is compute something called the value function. And I want to measure for this coalition, denoted by Q, predictor P's marginal contribution. So I evaluate the value function for when I plug in the coalition members, so predictors 1 and 2, and the predictor I'm interested in. Suppose I'm interested in predictor 3. So I have the value function computed at predictors 1, 2, and 3 minus the value function computed for evaluated at just the predictors in Q, so 1 and 2. So this is the value function with 1, 2, and 3. This is the value function with 1 and 2. So this has given us the marginal contribution of 3 for that coalition. We do this for all possible coalitions, okay, that we can form from the complete set of predictors, set minus P. So all coalitions that we can form, excluding P. Then we take a weighted average of these marginal contributions. And there you have it. Okay.
Can I just stop for a split second, David? So I guess if you have lots of predictor, you end up with a humongous amount of possible coalitions. Am I wrong or not? Is it an issue or not?
You are spot on, and it's a major issue, and I will address it momentarily.
Okay.
So now, a coalitional game in a prediction made by a model, they're not the same thing in terms of the value function. So we need to define the value function that we're going to use. And different value functions in terms of predictor removal define different Shapley values. Like, again, if we have 4 predictors and I want to evaluate the value function for 1, 2, and 3, what do I do with predictor 4? Right? I mean, I need to plug something into F hat, my fitted model. So what we do is there are different types of Shapley values that deal with that differ in how they deal with the removal of predictors. We use so-called interventional Shapley values. What do? They remove features or predictors, okay, by taking the expectation of F hat using the marginal distribution for the excluded predictors. So we plug in the values for the predictors in the coalition that we're interested in. The predictors that aren't in the coalition, we integrate them out using the marginal distribution of the excluded predictors. There's a very nice paper by Chen et al. They call this approach being true to the model. And again, there's not one. There's the so-called observational Shapley value, which uses the conditional distribution to remove the excluded predictors. Again, whether you use one or the other depends on the context. In our context, we argue, again, without going into the almost philosophical reasons, we use interventional Shapley values. And Shapley values have a number of attractive properties, including symmetry, missingness, monotonicity, linearity, and efficiency or local accuracy. And here we can see that the Shapley values provide an exact decomposition of an in-sample prediction. That's what we're saying here. So I have my fitted model, I plug in XIT, that gives me the prediction F hat. If I take the sum of the Shapley values corresponding to all the predictors, that will exactly equal the prediction in terms of its deviation from a baseline prediction. And think of the baseline prediction as just the average prediction, the prediction I would make if I didn't have any information about the predictors. So it's the prediction associated with the empty set. It would be something just like the unconditional forecast that you would use. Laurent, it's practically infeasible to compute Shapley values as the number of predictors increases. The number of coalitions just blows up. So what is typically done is, what is often done, different ways of approaching this, is to use a sampling algorithm. And it was originally developed by Castro and all, and we're going to expand on this. To do so, it helps to write the Shapley value in an equivalent form. In the interest of time, I won't go into that. But basically what you're going to do is you form an ordered instead of working with coalitions per se. You think in terms of ordered permutations. So if I have 4 predictors, I have, 1, 2, 3, 4, 4, 3, 2, 1, 1, 2, 4, 3, etc. So you consider all ordered permutations, and you can compute something. You can compute the Shapley value analogously to what we discussed before. You still have the marginal contribution in parentheses, in brackets here. Again, there are going to be many ordered permutations, so it's just not practical to consider all of them. So what do? We make a random, right? We randomly draw ordered permutations, compute the marginal contribution for the ordered permutations. And basically, practically what we do is when we integrate out predictors that are excluded from the value function, we just use Monte Carlo integration to integrate them out, which is akin to using the the marginal distribution for the excluded predictors. So that's what we do here. And then you just take the Monte Carlo average with some antithetic sampling to improve the performance of the sampling algorithm. We can compute the Shapley value for each predictor, and local accuracy holds. So for this sampling approximation, we also get an exact decomposition. Much of what the paper about is, again, we apply Shapley values, we extend conventional Shapley values to decompose in terms of the underlying predictors and out of sample prediction. Again, the excruciating details are provided in the slides and in the paper. We have a sampling approximation. Then we consider an investor who uses the forecasts right at the end of a month to do a forecast for each stock for the next month. You allocate across the stocks, right, using some sort of allocation strategy based on the forecast. At the end of the next month, we know the returns, we get the portfolio return. We show how you can use Shapley values to decompose the portfolio return. We're just extending, again, the notation gets heavy to say the least. But we're still going to use a sampling approximation to make this feasible. And then finally, we're going to take a sequence of out-of-sample forecasts, right, based on an underlying machine learning model that we update maybe every month using a rolling window or an expanding window. We use a rolling window on our application. And then we show how we define a Shapley value for a portfolio performance metric, and then we approximate it using a sampling algorithm. It turns out that computationally, you have to think carefully about constructing the sampling algorithm for what we do. So we have what we think is a quite computationally efficient and powerful algorithm for computing our new metric. And we hope to have it available in the near future in a Python package. We'll post the code at some point. Again, hope maybe time permitting, we'll be able to get it into the form of a Python package. And again, Lorraine, in line with your observation, you have to take some decisions, like, how many samples am I going to take of the ordered permutation? So on application, we use 50, which is often quite large. And when we use Monte Carlo integration to integrate out the predictors that are excluded, we're going to use 1% of the training observations. Because again, this becomes even using this sampling approximation, it becomes quite costly because you just have to evaluate the prediction function so many times. I mean, in the paper, we count how many times you have to do it. It's just a massive number. And so using 1% of the training sample observations helps to reduce the number of computations so things are feasible. But we tried 10%, and we have similar answers. You could try a completely different method that intuitively is based on permutations, or you scramble the predictor. So I want to measure the contribution of a particular predictor. What do? Well, instead of using each month, instead of using its actual value that I would plug into my fitted model to get a forecast for the stock return for that predictor, I just randomly draw an observation from this sample and plug it in. So I break the connection, right, in my fitted model between the predictor and the forecast. So I just randomly use values for that predictor and say, okay, how does the portfolio perform if I do that? So what's the Sharpe ratio if I use the actual values for all the predictors vis-a-vis for one of the predictors, I just randomly use values. You can look at the difference, and that'd be the contribution of the predictor. So that's much less computationally efficient, but in general, it's not going to have the nice attractive properties of Shapley values, and we'll show this in our application. Speaking of the application, can I have 5 minutes?
That's what I was about to say, is that if you can just give us some perspective of the empirical application during the next 5 minutes, that's going to be perfect.
Wonderful, thank you. So again, we have over 200 firm characteristics. Chen and Zimmerman have done superb work in open source asset pricing. That website is a phenomenal resource. We have firm level stock return data from Chris, so we're considering all stocks on American exchanges with some of the usual filters. Our total sample is from January of 1960 through the end of 2021. These are the predictor groups that we construct. We try to have the groups be relatively balanced in terms of the number of predictors in each group. Of course, there's plenty of judgment involved here. In the paper, we provide the exact characteristics appearing in each group. Again, we're going to use XGBoost. We're going to use a rolling window. We're going to train the XGBoost using data available through the time of forecast formation. We're very careful in how we tune the hyperparameters to try to optimize the performance of the XGBoost. We actually use the XGBoost in a classification mode where we where we predict whether a stock, what quintile it will be in. You could also treat this as a regression problem, and we do this as well, and then just sort the stock returns, but we find that the classification approach works better. So we'll focus on that. And then we just compute a long-short portfolio. The legs are value-weighted. So that's going to minimize the effects of small cap stocks, which we know can drive results, right, if we're not careful. Here's the portfolio performance. So the annualized Sharpe ratio, I mentioned in the introduction, 1.80, which I think is typically quite sizable the way these things go. And here we have the annualized alpha for the Fama French 6 factor and the augmented Q factor models. And you can see that these alphas are quite sizable. So here we go. This is in terms of the empirical application. Here's the SPPC in action. So we measure everything relative to a baseline portfolio. So the baseline portfolio that we use in terms of the Sharpe ratio is just the CRIS value-weighted market portfolio. It has a Sharpe ratio of 0.47. And so here's the contributions made by each of the 20 groups. And when you take the benchmark Sharpe ratio and then the contribution made by each of our 20 groups of predictors, you exactly get our 1.80. These are the 4 groups: risk, earnings, seasonal momentum, and momentum, that make the largest contributions in terms of the Sharpe ratio as well as the alphas. Okay. And you can see again, there are a number of predictors that make actually negative contributions to the metrics. Here we show how you can, for the alphas, you can look at the contributions of the long and short legs separately for each of the predictor groups. You can see overall, the long and short legs contribute about equally. But for example, for risk, it's really the short leg that's primarily contributing to the relatively high Sharpe ratio. So there's just a number of ways you can take a much deeper look at how these predictors are driving portfolio performance using the SPPC. You can see that there's somewhat of the portfolio, its performance in general tends to tail off in the latter maybe half or third of our full sample. And so we look at how predictor contributions change over time. Here's just portfolio performance for 60-month rolling windows. And you can see in general, we still typically outperform the market portfolio by a sizable margin, but overall, the outperformance isn't as large. In terms of the predictor groups, you can see, as I mentioned earlier, consider risk, right? So it contributes, in terms of the Sharpe ratio, it makes the largest contribution for the whole sample period. But this is its contribution over using 60-month rolling windows. You can see the contribution is very large through the first half of the sample, but it actually becomes negative for a number of periods. You can see earnings and seasonal momentum perform more consistently. They provide gains on a more consistent basis. Momentum has a momentum crash, to borrow a phrase, right toward the end. So again, now we can have a much better feel for how these predictors are contributing, not only in an overall sense, but over time. And then finally, my last slide. What we're in the process of doing, and we hope to have this done in a reasonably near future. So far, we've used this as a model interpretation tool, and I think this is vital, as I've emphasized. But we're exploring using the SPPC in real time to improve portfolio performance. Think of it as a monitoring tool. So as we move through time, right, we have some look back period where we measure the contributions to, say, the Sharpe ratio of the different predictor groups. And what could we do? Well, if we find that some predictor groups are make a negative contribution, right, we could try to integrate out or ignore the information from those predictors when we make our next set of predictions. Okay, and we generate our next portfolio, and hopefully maybe by using the SPPC and monitoring through time which predictor groups are most relevant, and in this context, which ones are least relevant and indeed detracting per performance, we can try to fine-tune the procedure, drop those that are detracting from performance, and then we're quite curious to see if this can help improve performance, especially toward the end of the sample. Because we can see some of these, right? You have predictors that go from contributing quite strongly to performance to detracting for performance. So that's it. I hope I did well on time.
Yeah, well, we were slightly out of time, but I think that for the sake of the interest of the presentation, that was really great. And thanks a lot for all your efforts in vulgarizing. I think we have now quite a clear picture. And before I leave the floor to Abraham, I would have a very naive questions about this kind of negative contribution you're talking about. So often when you say something is negative, then just short it and that's going to be fine. So that's going to have a positive contribution. I guess this is not what you're talking about here.
No.
Negative contribution here is something like it deteriorates the quality of your estimates or something like that. Can you just emphasize that a little bit? And then Abraham, I leave you the floor. Very sorry for that.
No, that's an excellent question and something we should make clear in the paper. So, right. I'm already taking long and short positions, right? So based on my model forecasts. So in that sense, no, I don't think it's giving you insight into, oh no, you should instead short that particular, I'm not even sure how you would do that, but no, it's because again, we're taking both long and short positions, right? And so it's just saying, hey, look at the short positions you're taking. Maybe one of the group of predictors is signaling, take short positions, take short positions. Well, taking those short positions actually is detracting from your performance. But the same could also be true for the long positions. Okay.
Yeah, so very good. Thank you very much. Abraham?
Yes, so thank you very much, David, for this excellent introduction to this field for me, bien sûr, of course. I have two very quick questions in the just to save time. One question is related to the question of Laurent. How are non-linearities dealt with in your model? The question is the following one. If, as Laurent said, you also have group of predictors who are contributing negatively, but still you keep them, your method keeps them, my guess is that there are some interactions with other predictors which offset this negative impact. While when you look at your predictive model, you are just using time t, and my guess is that you are not including some interactions. I don't know, it's just for a clarification. So to set up the question is, why do you use only time t predictors, and in your predictive function, don't you use the past time series? Maybe there is information in the time series on top of the current level of the predictor. One,
Okay.
and the related question is about the interaction between predictors. My second question, and I will leave you the floor. I will not invest in stocks with higher expected returns. Why? Because there is risk. So when you look at your Sharpe ratio, it's 1.8, 0.5 monthly. So it's great, but it's not impressive in my view, because we have seen other strategy generating much higher Sharpe ratio. So here is my question. It seems that you are generating a lot of volatility. Naively, what I will do is I predict the expected return, but I predict also the volatility. So then I will double sort on high expected return, low volatility, and I will long the bucket, high expected low vol, and short the bucket, low expected high vol. So
Sure.
voilà, these are my two questions.
No, those are excellent questions. Let me take them in turn. So for the first one, okay, let me be clear. So we're training a gradient boosting tree. We're using the XGBoost algorithm. So we're using a rolling panel of data, a rolling estimation window. So we train the model. So in that sense, we're using data, right, going well into the past, but that's just to train the model. Yes, then the model is specified, f of xit. So we're just going to plug in the value of the characteristics for month t for stock I to get the prediction. But yes, you could certainly have a machine learning model that uses more information that somehow explicitly models like a long short-term memory, even some sort of transformer structure. You could use more information. You could explicitly incorporate time series observations, again, further back in time directly into your forecast. It's just a matter of what type of ML model you're using. What you could use a neural network, right, of some sort. So we're following what has been done recently in the literature. But sure, for any machine learning strategy that you come up with, you could do that. So I certainly agree that yes, you could find machine learning models that perform better, right? It's all a matter of trying to find the best machine learning model. It might have more moving parts, be more elaborate. The challenge, of course, in finance is we're working in a very noisy environment, and so we just have to be especially mindful of guarding against overfitting. So and the XGBoost algorithm certainly allows for interactions, right? So it's a gradient boosting tree. So it's really interactions are playing a key role in our model. And then so your second question is similar in a way in that yes, I think it has to do with, okay, I have a set of forecasts that I generate using machine learning model. And you're suggesting, well, why don't you also forecast the second moment? Okay, sure, do that, use machine learning model, and then take those forecasts and form a portfolio. I certainly agree that that could result in a portfolio that performs even better. Maybe you could, again, form that portfolio in a way that's I mean, maybe you face institutional constraints, right, as a portfolio manager, what have you, that takes into account transaction costs, what have you. Our methodology can still be used, right? So however you go from your forecast, your return forecasts, first conditional moments, second conditional moments, correlations, conditional correlations, however you go from those forecasts to portfolio weights, we can accommodate. So again, this paper isn't about sort of the best way to forecast individual stock returns necessarily, right? We think we find a model that performs well, but it's primarily to say that, you can understand why your model, if it performs well or not so well, you can understand why. What are the key drivers? And that's improving our economic understanding and helping us to, again, peer inside the black box. So we have some, much better handle on what these models are doing. Does that make sense?
Yes, thank you very much.
Thanks.
Maybe slightly related before Thomas, you ask your questions. Is that if I understand well, you set up your groups of predictors yourself. Would there be a possibility to find some kind of an optimal grouping of the predictors that makes sense, not from an economical perspective, but from the kind of the metrics perspective? So maybe you group them. I'm pretty sure you group them differently. You're going to end up with different results.
Sure.
Maybe there will not be meaningful, but I'm curious about it.
Right. So we form groups just again to try to try to keep the computational costs more reasonable. But yes, ideally, I mean, and again, this is becoming more and more practical, right? Ideally, you just would work at the individual predictor level, and then in line with this, what we're working on slide that I have up, we would essentially do, Laurent, something very much along the lines that you described, right? We would consider all of them, and then as we move through time, right, we generate forecasts, and then as we move through time, we can just monitor all the predictors. And the ones that seem to be detracting from performance, again, according to some look back window, we sort of ignore the information in those predictors as we move through time. Now, again, this is going to be tricky, right? I mean, how long should my look back window be, right? I'm probably, if a predictor goes from doing very well and then in just a month or two, it just falls off a cliff, it's going to be difficult to pick that up in a timely manner, perhaps. But the idea is, if you come up with you can try some different strategies and find some that are perhaps robust and can help to significantly improve out-of-sample performance. So I agree. You can have a data-driven method for selecting the most relevant predictors. And indeed, you're selecting them in terms of what you care about most, portfolio performance. But we have to do it in real time, right? So we just need to be careful that we don't have to look at bias.
Thomas, maybe your time?
Yes, thank you very much for this presentation, sorry. And it's actually pretty interesting to see how Shapley values, which has been defined like 70, 75 years ago, can actually help solving a current problem.
Yes.
So yeah, my first question was more on the asset universe. So the analysis is conducted in the equity space, right?
Yes.
I was wondering just if it is applicable also to a multi-asset context.
Sure. You could, I mean, I I want to reiterate, I can't emphasize enough that our methodology is very general, right? So you can forecast any assets, the returns for any assets, including, you could have in a portfolio of international stocks and bonds, right? So you could have different stocks and different bonds. You could mix them, right? You could use any asset. You could use any predictors you want, any machine learning method, any prediction model method approach you want to try. A host of neural nets of all sorts, right? Feed forward, transformers, what have you. Any allocation strategy that you want to use in any portfolio performance metric. And we tried to set up the algorithm that implements the SPPC in such a way that this is relatively straightforward. I mean, this is like, so you could kind of, we can set up a package where you could do this and it would be reasonably painless. The key is you just need to evaluate in R or Python, the predict function. If you estimate a model, you typically, right, you take the fitted object and you put it in the predict function, and then you put a vector of values for the predictors to create a forecast. You're just using that predict function seemingly countless times.
Okay.
So does that make sense? Yeah, there's no, again, the empirical application, I mean, we think it's interesting, but it's primarily for illustrative purposes. And that's not we're not claiming in any sense that it's some optimal portfolio.
Okay. Do I have the time?
Yeah, you have the time for one last question, Thomas.
Yeah, one last question. Okay, thank you. So we had the honor of receiving as a guest speaker Professor Brian Kelly last September. So I was wondering if this paper actually helps justifying the use of hyperparameterized models against more parsimonious alternatives.
Wow. Okay. So, I mean, that's a deep question.
Yeah, because
sure.
as a student, yeah.
So I think I don't know if I think what we develop here, the methodology we develop here, is a model interpretation tool. So I mean, it can tell you if you have, say, a very complex model along the lines that Brian would champion. I mean, you have this very complex model, many predictors, just it's very highly parameterized, right? Yeah, so we can take that model and say, okay, if you examine its out of sample performance in terms of statistical accuracy or in terms of using the forecast to construct a portfolio, and you want to look at you want to analyze, say, the Sharpe ratio, which they do in the original JF paper. Yes, you could take our methodology and we're going to tell you which predictors are driving the results. I don't think we're necessarily, if you have, say, a simpler model, right? I don't think we can tell you, I mean, we could provide some insights, like if you have a simpler model and it performs better or worse, right? You could use our model interpretation tools to understand the roles of the predictors in the different models, the highly complex model and the simpler model, okay? And I think our model interpretation tool could perhaps provide some insights into why one of the models is performing better. At least it'll help you understand these models, both the complex one and the simple one. What predictors are driving the results, both in terms of improving accuracy or performance and detracting from statistical accuracy and portfolio performance. So I think it could certainly be part of the evaluation, but in and of itself, it wouldn't, because, you know, at the end of the day, you just want to say, okay, which model is more accurate, which model generates more economic value.
Okay. Well, thank you very much for this amazing presentation and very insightful discussion we had afterwards. We're at 2 minutes out of time. I think we made it on right on time. And thanks again a lot, David, Abraham, and Thomas for this discussion. Next week we're gonna have another speaker series that's gonna take place with. Can I do that? Can I share that? Let me try share. That should be working. Yeah. So we have the next speaker series with Michele Mazzoleni, who is analyst at Multi-Asset Solution Capital Group, and he's going to talk about unintended consequences of rebalancing. And our host professor is going to be Nikolaos Tesaromatis. Well, I hope to see you all next week. And in the meantime, David, thanks again a lot for this presentation. That was highly insightful, and I'm pretty sure that our students highly benefit from it. Thanks a lot again.
Yeah. It was my pleasure. I thoroughly enjoyed it. Thanks for the invitation again, and thanks for the wonderful conversation.